Imagine getting $1,000 a month every month without lifting a finger. Well, that's the idea behind passive income. And one way to earn passive income is by building a portfolio of dividend-paying stocks. So how does it work? And is it too good to be true?
By including dividend-paying stocks in your portfolio, you can start to generate a stream of passive income. And when you retire, then you can still have these dividends coming into your bank account.
Dividend stocks are shares of listed companies that pay investors a portion of their earnings regularly. Building a portfolio around such stocks rewards you with a steady stream of income in the long term. So, if you want to generate a monthly dividend stream of $1,000, how much capital do you need? The answer? Quite a lot. So it pays to start investing early to build up that nest egg.
You can start small, just investing $20,000 to begin with and a monthly contribution of $600 a month, taking a total time period of 15 years by investing into a diversified strategy of global bonds, dividend stocks, and REITs. You can expect to generate close to 5% dividend yield. If you reinvest these dividends and alongside also generate some capital appreciation, roughly between 1 to 2%, with a total return close to 6.5–7%, you can expect the value of this portfolio to grow close to $240,000 over the course of 15 years. Now, this $240,000, if you multiply by the 5% dividend yield that you're generating, you get $12,000 per year, and then divide by 12, you get your $1,000 a month portfolio.
$1 today may not buy the same value of goods in 10 years. That's because of inflation. So when constructing your portfolio of dividend stocks, aim for stocks that give you at least between 5 to 6% in yield.
Inflation has been pretty high in the last few years, ranging from like 4 to 5%, but over the long term, it's usually around 2 to 3%. So as long as you're generating a return of 5% or 6% on your dividends, I think you can safely beat inflation.
According to experts, banks, REITs, and telcos in Singapore are some sectors you can consider to help you achieve that 5 to 6% yield, even with interest rates expected to head lower.
Banking stocks, for example, DBS, UOB, OCBC, they pay north of 5% as dividend. That's really good, I think, from a Singapore perspective. REITs pay more than 6%.
REITs or real estate investment trusts. If you look at some of the more popular ones like CapitaLand Integrated Commercial Trust, as well as Mapletree Industrial Trust, Mapletree Logistics Trust, as well as some Fraser Centrepoint Trust. These are some of the more popular ones. They are offering dividend yields of between 5% to 6%. And of course, one more sector that a lot of investors may be familiar with will be telcos, which is your Singtel and StarHub. Singtel is paying around probably like 5.2, 5.3% dividend yield, while StarHub is offering about 5.5% dividend yield.
However, along with local stocks, you may want to add in some global names. This will help spread out your risks.
I would definitely recommend a more diversified strategy. So it means that you should have some investments in the US on a global basis and some investments in a more local market perspective like Singapore.
To make your money work harder for you, make use of compounding. That simply means to put earnings from your investment back into your investment so that your initial investment grows bigger, giving you bigger returns.
Let's say you have starting capital of $10,000 and you can enjoy a dividend yield of 5%. So on the $10,000, you'll be able to receive $500 worth of dividends in year one. Okay, so if we assume that you invest $12,000 per year or $1,000 per month, this $12,000 is then added to your initial capital base of $10,000 and the reinvested dividends of $500 to form a new capital base of $22,500 at the beginning of year two. So on this capital base of $22,500, if you apply the same dividend yield of 5%, you'll be able to enjoy an annual dividend of $1,125 as shown here. So if you rinse and repeat the entire process all the way up to year 15, you can see that in year 15, you'll be able to receive $12,749 worth of dividends, which translates to an average of $1,000 of dividends per month.
Building a dividend income portfolio requires time and research, as you need to pick and choose stocks individually. If you do not have the time to actively monitor and manage individual stocks, consider an exchange-traded fund or ETF, which invest in a basket of stocks. ETFs are also considered to be low risk, as they are low cost and diversified across different stocks or even other securities.
So you'll need to put that research yourself in trying to figure out. So there are terms like dividend aristocrats, dividend kings. These are stocks that you could look up to where they have consistently increased their dividends over the last 25 years or the last 50 years, right? One way to get around that is to either choose an ETF or a fund instead of picking these individual stocks.
Investing in dividend stocks carry risks. Look out for dividend traps, where dividend yields are high but not sustainable. For example, a company could have weak fundamentals but uses debt to pay dividends. Share prices of some companies could plummet once a company stops paying or cuts dividends, usually a sign of weakening financial position.
It doesn't mean that all companies, the dividends will increase in a straight line. When companies don't do well, like for example in a recession or when there's an economic downturn, they may reduce their dividends.
Investors also need to be wary of irregular payouts, as dividends are only declared in certain periods of the year.
Most companies have their year end in December or March. So what happens is when they declare a dividend and eventually pay it out, it usually comes in the months of May, August, September. So you have to understand that certain months you may not get any dividends at all, okay? Whereas other months you get a big influx of dividends. So in a nutshell, it's very irregular.
While dividend-paying companies may give you stable returns, they might not have as much potential upside as high-growth companies. That's because high-growth companies tend to reinvest their earnings into itself to drive future growth. Also, avoid stocks with extreme volatility. Share prices of high-quality income stocks tend to be stable and do not fluctuate too much.